Welcome to Barchart's weekly webinars to enlighten you, the trader investor, of advanced strategies in concert with Barchart's tools and pages to make you a more educated and well-rounded trader. Today's subject, using Bollinger Bands with long-term trend analysis for futures markets. So, hang on, let's get going here. Wake up, computer. Wouldn't it be nice if we had a tool that could tell us when a trend is about to be extended or that it is time to get out, or gave us permission to re-engage our trend to get back into a trade? Well, that's what we're going to learn about today. We're going to learn about Bollinger Bands, and Bollinger Bands will give us that tool to give us a better timing of what is going on with our trends and when we might be using caution or looking for an opportunities to reassess our risk, and also look for opportunities to engage our trend. Hi, my name is John Rowland. I am your presenter today, and hopefully I will show you these advanced trading techniques in combination with our chart analysis with Bollinger Bands and Barchart's unique 918 MACD trading guide. We're going to kind of blend those all together. With me today, as always, is our moderator and purveyor of all things Barchart, Jean Baker. Hello, Jean.
Hi, John. Hi, everybody out there.
How are you doing today?
Just great. How about you?
I'm in a very chipper mood. I'm starting to get that festive feeling. Not yet there yet, but hopefully, looking forward to Christmas. I was asking you before, you hadn't gotten your Christmas shopping done yet, but I think I'm all done, so I'm pretty excited about that. One less thing to worry about, right?
Good for you. That's great.
So I want to show you guys. Just remember that our webinars are all. Hang on here. Our webinars are all recorded, and that you can find that archive of library of webinars under our tools, free webinars, and go in here. Now, the reason why I spend a little bit extra more time on this than I do on other ones is I want to reference a couple of previous recorded webinars, because we're going to talk about a lot of base information and we're going to build upon that base information. So, some of the techniques and stuff that I'm going to be talking about, the concepts, have already been described in other webinars. And the 2 or 3 that I want to highlight to you is finding opportunities using Futures Trading Guide, that webinar from July 29th, and Futures Trading Guide Help from September 2nd. And the other one that I want you to be aware of is down here, which it says Futures Risk Management Techniques. So those 3 webinars, I will reference those throughout today, will give you some of that base information that I'm going to assume that you have already have as we build upon that today. So again, I'm going to apologize ahead of hand that I might go very fast today, right? Or I might get into some more technical or detailed information. And so don't get upset, don't get discouraged if it goes too fast or it goes over your head. The webinar will be archived for you, and you can go back and you can reference it, and you can always come back to it. Now, always remember that if you have any questions specific about how to create templates or charts or any of those kind of things, that we do have a support staff. And I remind you that you can go down here to the bottom of your page under the contact Barchart. You can send your questions in. Jean's here to help too. She can hopefully address some of those questions. Okay. All right. Just a little business here. Just remember that futures trading for sure is a highly risky proposition, and that a decision to buy, sell, or hold any securities, commodities, or other investments involves risk and are best made under the advice of a qualified financial professional. And that the examples and things that we're going to talk about, strategies to talk about today, are for educational purposes only and should not be construed as endorsements to buy or sell, in particular today, very specific commodities or futures markets. And just remember that, in life and like in trading too, that past performance is not indicative of futures results, and that, we have this expression that, a trading system works until it doesn't work. So I just want you to be aware of that. Okay. So now that we have that out of the way. All right. Okay, hang on. Well, we don't want that one. We want this one. All right. Okay, so where do we start? Well, we're going to come into our futures, and we're going to go to long-term trends. And this is where we're going to kind of get some ideas about longer-term trends in terms of futures markets. Now, I have the chart view up here, but we do have other views, so we'll talk about those in a second. And what the chart view here does is it ranks the futures markets in terms of our weighted alpha. That's one of those proprietary tools that Barchart gives you. And weighted alpha is basically just looks at a larger weighted alpha. It represents a larger price movement in recent terms versus over a longer period of time. It's really how much has price appreciated over a year, but it gives a greater emphasis to price movements in the shorter time frame. So if I went to performances and I'm looking under bullish trends and I'm looking here at Bitcoin, you can see my weighted alpha is 275%, but we can see my year to date and my 52 week is only 150%. So you see it's much greater than a year to date because there's more emphasis in the most recent price action. And you can see that, in the last month, we were up 37%, and the last 3 months, we're up 60%. So, talking about, in the last 3 months, we're up, almost half of what we've gained in the last year. So that's why we have this greater alpha, all right? So let's talk about the elephant in the room here, okay? So we see this huge alpha for Bitcoin, and Bitcoin right now is an anomaly, all right? This is not normal for us in terms of looking at longer-term trends and alphas. This is something that is very, very unusual. So rarely do we see futures markets double in price within a year. Not saying that it can't happen or fall that much. I'm not saying that that can't happen. It's very rare. It's very, very rare. So we need to be more conscious that when we're looking at these alphas, we're going to be looking at ones that are more realistic, as you can see here, in that 25, 30, 40%. I think that's where we're going to find some of the better opportunities. All right. The next thing that we're going to do is, just because we see a market and we see a dominant trend or we see a nice alpha that we like, we just don't jump into those markets. And we need to make some qualifications or some criteria to tell us if we have the right, or we can, or do we want to trade those markets. So for instance, I'll go back to Bitcoin here. If I click on the Bitcoin symbol, and those two criteria that we're going to look at to define if I want to trade this market, I'm going to look at what is called margin. And again, this is a concept that we present in those other videos or sessions. And you can see here the margin under the contract specs for Bitcoin is $32,000. And that's a lot of margins. Probably most of us, including myself, is not a margin that I feel like I would feel comfortable trading. The other element that I'm going to look at is liquidity. And I want to make sure that my market has enough volume and open interest to support my activities. And so I can come down here to under where it says all futures prices. And if I click on that, it's going to show me all the futures prices in the Bitcoin world, and also it'll give me a volume and open interest assessment. And so you can see here that the volume for Bitcoin today is about almost 7,000 contracts, and the open interest is 8,000. Now, that is not a lot. I know that seems like a lot, but trust me, it's not a lot. So we want to make sure that we have enough volume to support our trading activity, and we have open interest. The greater the open interest, more market participants, especially institutional players, are making commitments to those markets. So, just kind of as a reference, again, don't hold me to this. I think, volume-wise, I want to see at least, somewhere in that at least 10,000 to maybe 25,000 on a daily basis, and open interest, I would say somewhere in that 30 to 50,000. Those would be the minimum thresholds I would look for, but we could look for some greater volumes and open interest. So, in my main view, right, I can look and will show me volumes, and you can see that. There are many contracts that have that high daily volume that we're going to look. Now, look at lumber. That's the next one that is one of the longer term trends ones. And you can see the volume for lumber is only 161 contracts. And if I click on just lumber itself, this will take me directly to that volume open interest page. And you can see that, we only have about, in all the lumber contracts that we could trade, we only have about, a couple hundred volume. And I don't even think we have just basically about 3,000 open interest. So again, another market that, is doing very well and is trending well. I mean, I just want you to understand you are taking on a liquidity risk when you trade these lower volume, lower open interest markets. Okay. Oop, I think I went back too far. No, I'm good. Okay. So in this view page here, those are our regular ones, our default ones that is provided for you, our chart view or performance main view. But I also have a custom view that I've created for myself. And again, if you want to learn how to do custom views, you can, there's some tutorials in the site education, or you can ask for some support. And so what I've done is I put in some elements in my custom view. Last price, right? Some basic kind of stuff. DTFN, that stands for days to first notice day. And this goes into that discussion about rollover and expiration and how we move from one contract to another. So what I'm really looking for is I want to make sure that there's enough days to first notice day for me to catch one of these longer trends. Notice like the NASDAQ mini right now, there's only 15 more days left for me to trade this contract. It might even actually be less than that because this is calendar days and not trading days. All right. Here's my margins, right? And so you can see that these top 5 here have very, very high margins. Matter of fact, you thought Bitcoin was high. Palladium is one of the highest margin markets out here. But if I go down here a little bit lower, I do see that, soybeans is only about 1,900, 2,000 margin. So again, don't hold me to this, but as a general rule, especially for those of you who are just starting out in the futures market, or you want to try to experiment or practice trading futures, I would say let's look at markets whose margin is $2,500 or less. Those markets will be a little less volatile, allow you to gain that experience, and you'll be able to manage risk a little bit easier. All right. Previous high and low, why do I put those in here? Well, I'm going to look and see what my last price is versus my previous high and low, and then see if my trend is continuing. For instance, you can see here that yesterday's previous high and low for lumber, the high was 648.90, and today the last is 652. It's telling me that price is above yesterday's range, and that means that this trend is continuing to go. Now, if I look at soybeans, right, we see just the opposite. Here was our range from yesterday. Our low was 1161 and 2.28, and our most recent price is 1156. That's telling me that price is below yesterday's range, and that could be problematic for me in terms of my trend analysis. All right, ATR, that stands for average true range. I'm not going to go into that. Look in the risk management webinar, we go into the detail about that. The MACD, the 918, this is definitely something we're going to use. We're going to incorporate this in our Bollinger Band discussion. And you see, it has given us a signal, a buy or sell signal. So I'm going to show you where we can find that in a moment. So you can see that on these bullish trends, we have most of these have buy signals. That's what we normally see. But we do see ones that have sell signals, and that could be a sign that my trend is about to change. That could be problematic for me. And if I look down here in my bearish trends, notice that our energies all have buy signals. Again, this could be an indication of a bottoming action or a major correction inside of this larger trend. My 9 to 18 MACD strength and direction, well, what this is telling me is I'm looking at momentum of my trend. The strength is based on what is the overall trend, the strength of the overall trend, and the direction is what is happening in the most recent time frame, about 3 days. So again, what I'm going to look for is what we call diversion. So I want to see where, maybe my overall trend has very strong, but I might see some weakness. In other words, that means that we could be in a corrective mode. Now, notice for soybeans, our overall trend is soft. It's not very strong, but it's still trending up, but we do have some weakness, and that might be a sign of a change in trend or a change in momentum. And then the difference between our larger trend and our MACD is kind of that macro diversions, right? So strength and direction, momentum at the trend level, trend MACD signal is at that macro level, that trend level. All right. Okay. So let's go here. Why do I use the 9 and 18? Well, this is under our futures trading guide, right? That will show you the system that we've created for you guys to use that is based on the 9-day moving average as it relates to the 18-day moving average. And what happens in this is that when the 9 crosses over the 18, it generates a buy or sell signal. Now, that buy or sell signal can be an entry or an exit. So we can see that for soybeans, right, we have a buy signal that's telling us the 9 is now above the 18, and that signal was generated on October 7th. And as of today, that position, a one-lot contract position, would be up $5,250. A nice return on this particular system. So, this system has a lot of merit to it. I would encourage you guys to go in a little bit deeper and watch this. But, they're not all winners. There are some losers as well. So, trading is a series of winners and losers. But we can look at a soybean. So remember, our soybeans trend was up, but it was soft, but our direction was the weakest. And here is a 6-month daily chart, and you can see that uptrend is in control. But in recent days, price has backed off a little bit, right? So it's a little bit weak. So our trend, we're still in an uptrend, but we're probably in that corrective mode. So what can I do here? Well, I can look for either buying opportunities as the market comes back and re-engages my trend, or, I'm going to use some risk management that says, hey, you know what? For instance, if I go back to October 7th, where I got that buy signal, here it is right here, right? How much profit have I taken, or how much profit has that trade come? That might give me permission to make some risk assessments, either to tighten up my stops, take some profits, or reevaluate my trend, okay? All right. So we want to look at, let me just show you something here for a second. Okay, so over here is our templates. These, again, you can create these on your own, and I have a 9-18 moving average template, and I just want to show you this for a second. Now, my template also comes with Bollinger Bands, so I'm going to take the Bollinger Bands off for the moment. And I just want to reinforce that here's where that 9 crossed over the 18, and we got that buy signal, and this trend has been continuing on. But now we see our momentum, our price momentum has changed, right? Our 9 is starting to turn and price is now below it. And, we've come back and engaged this 18-day moving average. Now, this is where we need to be a little bit more dynamic or proactive with our risk management, because think about this. This trade is up $5,000 right here. But if this market continues to go down, when I get that sell signal, when the 9 crosses back over the 18 to give me that sell signal to get out, price is probably going to continue to go down, and I'm going to lose a lot more of my profit. And there might even be a scenario where this trade can go from a winner to a loser. So we don't want that to happen. So that's why we're going to use Bollinger Bands to give us permission to look for opportunities to lock in profits or to make some new decisions in terms of our risk management. All right. So that's what we're going to kind of build out in the next few minutes here. All right. So that is our moving average MACD. All right. So let's do this. Let me turn that off for a second. And we're going to go to right click and add study, and I can add all those different studies that we showed you. You could find, I'll show you in a second, excuse me. And there's Bollinger Bands. And I'm just going to lay this over now. We'll come back and revisit this. And so here's what we're kind of going to be looking for is we're going to wait for prices to get outside of our Bollinger Bands, or when the market is telling us that price has gone too far too fast. And I'm going to give you that definition in a second, but also where we can re-engage our trend. So let's learn about Bollinger Bands. So I'm going to go into Tools, and underneath Tools, I see technical indicators, and here we have a library of technical indicators, any one, more than you probably would ever use in a lifetime of trading, trust me. And then there is Bollinger Band. So let's click on that. And let's talk about what we see here. So inside of these, you're going to see the methodology, the math, and the common interpretations for the different strategies. All right. So let's look at this right here. What's our methodology? Well, first of all, Bollinger Bands are an overlay, which means that we're going to put this on top of something. We're going to put this on top of a price chart, or we're also going to use it in conjunction or in concert with another indicator. And the indicators that work well with Bollinger Bands are momentum indicators. So remember, our 918 is kind of a momentum indicator. And that Bollinger Bands consist of a moving average and 2 standard deviation lines, one above and one below the moving average. So the middle line is our moving average. Now, it's really referred to, when we talk about Bollinger Bands, is referred to as the mean. And when you talk about statistics and the collection of datas, we have means, we have modes, and what's the third one? I'm having a senior moment here. Oh, median, right? Medians, right? So it's gonna be more commonly referred to as the mean. The other thing is that the outer line will be referred to as a band, an outer band, and so that those outer bands represent 2 standard deviations above or below our mean. All right. Okay, so let's talk about the math. Now, I'm going to make it simple for you here, okay? Really boil it down for you. All right, so here's the math. I want you to imagine a bell curve. Remember those? And the bell curve was kind of like, it looks like a hump, right? And the mean would be the middle of the bell curve at the apex of that bell curve, right? So one standard deviation, right? 68%, to be precise, 68.3% of all price action falls inside of one standard deviation. All right, so let me put this in kind of in general terms. 2 out of every 3 days, the market will stay inside of a 1 standard deviation. That's kind of where price likes to be when markets are normal, right? And that 95.4% of all price action is inside of 2 standard deviations, right? So when we look at a 2 standard deviation, outside of 2 standard deviations, it's only happens less than 5% of the time. It's a very rare occurrence, and this rare occurrence is going to give us those indications, those alerts, those signals that something unusual is happening, all right? If I think about this in general terms, again, something so you can kind of digest it, there's 20 trading days in a month. That means about once a month do we get a 2 standard deviation price movement. Now, can we see multiple days of price movements outside of 2 standard deviations? Yeah, for sure. We're definitely going to see that. But I'm just kind of giving you kind of a general interpretation of what standard deviation is, okay? All right, so what are some of the ways we can use Bollinger Bands? Well, many traders will use Bollinger Bands to determine if the market is overbought or oversold. All right, that's one concept. To confirm divergences between price and studies, that momentum discussion, and also to help project price targets, not only exits, but also help us to project entries. Wider bands are greater volatility in that particular market, and narrow bands to a lesser extent, lesser volatility. So I want you to think about this in this terms. Okay, think about Bollinger Bands like a rubber band. Okay, and if we have a rubber band in our hand and it's just sitting in our hand, it's at a relaxed state, right? So many times Bollinger Bands will come into a cycle of relax or consolidation, or sometimes referred to as coiling, right? And then if we pick that band up and we start to pull it, right, we test its elasticity, right? If I just pull a little bit and I let go, it doesn't really snap back that hard. But as I stretch that band farther and farther apart, that rubber band farther apart, creating greater elasticity, that when I release that pressure, right, the rubber band snaps back. And so that's what we're going to look for. We're going to look for, as bands go from a coiling to these expanded extremes, right? And what we're looking for is that the Bollinger Band is going to tell us that price has traveled too far, too fast. And that when that pressure is released, when price reverts or comes back inside of the upper band or the lower band, that it's going to snap back to what is our resting or normal moving average, and it will snap back to the mean. This is called mean reversion. This is the basic theory about Bollinger Bands. So 2 concepts. Coiling can lead to expanding the band, stretching the rubber band, telling us that we have a strong trend. But if price goes too far, too fast, and we really stretch the width of the bands, now we're on alert. When price goes outside of that standard deviation, that price can snap back. All right. The other concept I want to employ onto you guys is that Bollinger Bands can be applied on any chart and any time frame. But although the study works best with daily and weekly charts, and that when we apply it to a weekly chart, and this is really what we're going to look at, is that it is more significant for long-term trend changes. Okay, so that's where we're going to start our discussion. All right, so I'm going to go back to, I did this before. I was watching this. Okay, so let's go back to my interactive chart. And notice here I'm on my 6-month daily, right? If I drop down this menu here, I can change my frequency to an intraday, hourly, minutes. I do have daily nearby. I have weekly and weekly nearby. Let's talk about this just briefly. Daily represents a picture, the chart is representing only the price action that is unique to the contract that we're actually looking at. If I look at a daily nearby, the first one is called a contract specific chart. Daily nearby is a collection of price action of the month that is the most active, or the front month at the time when that candle was, or that bar was being created. And then as we go through the cycle of expirations, then the chart will continue as it goes to the next nearby. So this chart is good for helping us find trends and maybe targets, but it's not a great chart for finding entries. We want to make sure if we're going to look for entries, we always want to use a contract specific chart, a daily chart or a weekly chart. Now, if I go to a 1-year chart, notice that my default is still daily, right? But if I go out to a 3-year chart, now my default becomes weekly. Now, if I go to a contract specific weekly for soybeans, notice that I have no price data beyond this point, because this contract was not around, it wasn't existing. So if I go to my weekly nearby, that's going to fill in that data for me. So I'll have that. And again, remember, I'm not going to use that data for entries, but I can use it to help me define my trends and also help me do some targeting. So let's do that. So I'm going to just pick this most recent high, right? I'm going to just go right click here. Right click, wake up, there we go. Drawing tool, and I'm just going to draw a horizontal line at this weekly high. Again, targeting, one of the things that we can use for our weekly chart. And you can see that in this scenario with our soybeans, that we have now reached this price that we haven't seen since 2013. This contract wasn't even around in 2013. So that could be significant for us in terms of our assessment of soybeans at this moment in time, okay? So let's turn on our Bollinger Bands, right-click Study. Again, I can come through Study through here, and notice here we have our period. That is our moving average period. The default is 20. So if I'm looking at a weekly chart, it's 20 weeks. If I'm looking at a daily chart, it's 20 days. If I'm looking at a 60-minute chart, it's 20 60-minute periods. And the width is our standard deviation. And you can adjust that according to, I know some traders who like to look at 2.5s and 3s, and day traders might look at 1.5s. But the default here is 20 and 2. Okay, so we're going to add that to our chart. And now what is going on here? So we're going to use our weekly time frame to give us our marching orders, our marching papers. We're going to look at our trend, we're going to look at the big picture, and we're going to discern what is going on with my trend and what things I need to be aware of and what things I need to be cautious about. And so my trend is certainly up, right? But you can see that our bands, right, have gone from that coiling, right? That coiling to that breakout, the momentum, right? The momentum breakout. And now momentum is bouncing off of that most historic high, and price is now starting to fall, right? So what would Bollinger Band say? Well, Bollinger Band says that now that price is back inside of my band, that there's maybe a greater propensity for it to come back to the mean. Now, it might not, but that's what I need to be aware of. I need to know that maybe this trend has stalled, the momentum is stalled, and I'm going to look for either a patient entry or wait for a confirmation of my trend to come back. Or if I was in this trade, I was long this trade, it certainly would give me onus to say, hey, you know what? Maybe it's time to take a little profits, or maybe even to exit that trade. So I'm going to look at weekly to give me that big picture. What am I looking at? What am I anticipating in my markets? All right, so I'll go back to my daily chart now. I'm now in daily chart, and here we can see that scenario playing out, right? So one of the things that Bollinger Bands can be used for as well is when we see that price divergence. Remember, that's what we saw, one of the interpretations. And so what we see here is that our soybean contract is bouncing off that high, and we've tested it now 3 times, and each time we've tested it, we've dropped lower. So this is a change in momentum, right? Change in momentum. And notice now that we have reverted back, or mean reversion. So that could tell us that our trend is now going to re-engage and push price back up, or we could be seeing the beginning of a new trend change, right? Now, remember our MACDs are 9 and 18s. Well, again, that template that I have, I'll add that back on. And here you can see that this would have given me more of an indication that I want to take some profits, or at least tighten up my stop, because I've bounced off against a target. My price has diverged. My moving average has turned. My momentum has changed. And so, I might get out of this trade at this point. But now that I've re-engaged my mean, this also could give me an opportunity to come back into this trend. Notice over here, we had our coiling where we broke out, right? And we carried along the Bollinger Band, right? Carried along with it, and then we got a green candle outside of it. Now, ideally, we like to see the whole candle out, or a good portion of the candle out. But if you have a large wick, or what sometimes referred to as a shadow outside it, that would be significant enough. But then here you can see how price has returned inside the band, and so there's a greater probability that price is going to snap back to our mean. So if I was long this trend, I might, look to take some profits right here when my price drops below my 9-day moving average. But then I could come back in when it re-engages that mean. Now, what I might do is use another qualifier. I'll say, I'm going to wait for price to re-engage my mean to come back to my trend, but I want to see that buy signal again and that positive momentum. So I'm going to wait for price to go back above my 9-day moving average. And that would have gotten me back into this trade, right? I would have caught all this, collected that profit, waited for the mean reversion, got that positive signal, right? And then got back into the trade. Again, here I would have been stopped out, waited for it to come back to the mean, and then get that buy signal to let me collect that profit, right? And now price has changed again, so I'm going to step away from this trend, and I'm going to wait for price either to buy it down here on this mean, or I'm going to wait for price to turn and go into a positive momentum. Now, one of the cool things we can do about this is, if I'm looking for these entries based on mean reversions, or based on testing my moving average, what I'm going to do is I'm going to get rid of my template for the moment, and now I'm going to go down to even a lower time frame. So I'm using weekly to get the big picture, right? Where I am, where how price can go, how far has price gone. Now I went to the daily, I did my trend analysis. Now I'm going to go to my lower time frame. And here is where I'm going to help myself find some particular entries, all right? So let me make this a little bit larger for you so you can see it. And if I go back in time, the kind of places where I like to look for entries is, I like to see big explosive candles. Now, this would have been an entry that I might have thought about, but I also like to see big explosive candles where price breaks above recent highs, right? And so you can see that we see that here, right? Not only did price stop going down, but it gapped up, and this gap up took out these 2 or 3 highs, and that would be a good sign that there's probably still some buyers still down there, and that's a good spot where my trend should reinforce itself. So what I'll usually do is I just draw a couple lines to help me define that area. And, I'm going to do some risk assessments in here as well, right? So this is where price stopped going down, and that's where it accelerated away. Now watch this. Let me go back to my 6 month, right? Turn back on my Bollinger Bands and my moving average. And notice that that area where price re-engaged our mean was a potential buying opportunity. That's kind of a cool thing how this works out sometimes. A lot of times you'll find that the zones that you're looking for, the entries that you want to find, it's going to teach you a little bit more patience. So look for those that are around your moving averages, around your means, right? So here you can see for today, it came right down into that zone and it went all the way to the edge of it, but now it's back above it. Right, so now I have permission to say, hey, as long as price continues to go back up, I can jump back into this trend. All right, I see a lot of questions here. I'm going to try to answer them at the end. Let me just keep moving forward. All right, so I promise we'll try to get to there. All right, let's go to another market. And everybody loves gold, right? It is Christmas season. Okay, so let's start at our 3-year so we can get to our weekly. And we're going to right click, turn on our study. Again, we can go through here, through study, and turn on our Bollinger Band. And what do we see here? Well, we see that discussion again, where we've come from a contraction, and now our bands are super, super wide. And price is now outside. And again, that's what I said. We want to find that whole candle outside the band, a very low probability event, high probability that price is going to revert back to or revisit our mean. And you can see that gold did do that. It re-engaged our mean, re-engaged the trend. And it looks like price tried to go up. Right, and then it came back and tested the mean again, and it went up a second time, and both times it failed. So now what we're seeing is that this uptrend has failed, and that we are starting to see the beginnings of a downtrend. Now, where are we on the Bollinger Bands? Well, we're in the oversold part, right? We've gone outside of our Bollinger Bands. That's telling us we're outside, right? A high, rare probability event that maybe price is falling too far, too fast in this time frame, and that there might be a propensity for this market to revert back to the mean. Now, that might be a buying opportunity. I could take a contra trend trade in this scenario because this is a downtrend, right? And I'm buying. So if I'm going to take a contra trend trade, I want to have a tight stop and a very realistic target. But if I want to re-engage my trend, maybe I'll wait patiently to wait for price to come, maybe higher up here. So if I go to my trend time frame, right? Here's my trend time frame. And what do we see? We see that downtrend, right? We see it's very clear and obvious to us. Now, this is what we want to see. We want to see an overbought situation in a downtrend. That's what we want, right? We want to see price come up too far, too fast in a trend that we believe that's in control. And this would have been a great selling opportunity. But if we missed that, it's that selling opportunity, there still could be other opportunities for me to come in as my price now has gone from oversold and now it's going to step back or snap back to my mean. Now, if I added my 9 and 18s, my moving averages here, you can see that today we are engaging that 9 and 18. So that could mean that price could come all the way back up here. Or if I had done a contra trend trade, this would have been my first target, right? I would have had a nice little trade here. Maybe I bought around 1778, 1789, and now we're up to 1825. I mean, that's a nice $4,500 profits on a little Bollinger Band correction move, right? But I can also look for another entry. So again, I'll come back and turn off my studies, and I'll go to that lower time frame, right? That 60 minutes time frame. And again, I want to look for those areas where I see price explode away and make new lows in terms of a downtrend. So I see a nice big candle here. That would definitely be an area where I would be looking to put an entry. I see another one right here. I see another one right here. So let's put a couple of those in there. So we have one here, and let me put one more here. Let's put one right there. Okay. All right. So go back to our trend time frame and turn on our templates, our moving averages, and our Bollinger Bands. And gosh, look what we see here. So here would, again, stating that I might wait patiently for price to come back to that area where it exploded away from, or you know, targeting, right? Targeting for my contra trend here, you know, those two zones that I just drew that were on top of each other. That could be a place where I want to take some profit on this correction, or I maybe come back into taking a short position here. All right, so I do have that opportunity to do both of those. But if I wanted to wait and see that price goes down, maybe I wait for a confirmation where this green candle turns back to red, and then price will continue to go down. Okay. All right. So the other one I wanted to show you guys was crude oil, where we saw that crude oil was one of the ones that was in a downtrend, but in recent weeks, we saw a buy signal from our 9 and 18. Okay. So again, I'm going to go to my weekly. Now, crude oil is one of those markets that we don't need to worry about contract specific versus continuous charts, because we can stay contract specific for a much longer period of time. There's a lot of crude oil contracts have been around for 8-10 years, right? So I do have some targets here. I do see, well, first of all, let's turn on our Bollinger Bands. And so what do we see? Well, first of all, I do see some targets here. So let's just draw one here. And right about there. And let's draw another one a little bit higher up here, right? So there is room for this market to go higher. That's what I believe. What's going on? Well, my bands have gone from, right, stretched that rubber band, right? We really stretched. Now we've come back to the mean, and now the market's kind of waffling around. But we did go from a cycle of oversold to 4 weeks in a row. Now we have a developing uptrend, and it looks like, doesn't it look like our bands are starting to what? Starting to widen again. So this could be that time where we're starting to stretch those bands. So as long as the market continues to maintain its momentum, remember our 918 said it was a buy signal, even though this market is in a downtrend. This could be a bottoming or beginning of a new uptrend. Is there room for this to run? Yeah, there's a lot of room for this to run in terms of targeting. But where are we on our Bollinger Bands right now? Well, we're on the outer edge of the overbought. So again, in this scenario, when I go to my trend time frame, I'm going to see that price has accelerated, but maybe I still need to be a little bit patient, see if I can get a bit of a retracement in my market. All right, and that's kind of what we're seeing here, right? Here we do see that we went from oversold, right? That would have been a nice buying opportunity, but once price got back above our mean and then started to take off, that would have been also a buying opportunity. If I looked at my 9 and 18, there was the crossover right there. That would have been a nice trading opportunity, and you would have been in this market somewhere around $40.50, $41, and it ran all the way up to $46. That would be a nice $5,000 return just waiting patiently until that signals the momentum and the Bollinger Bands telling you that the market is about to make this new trend. Now, what have we done? We've come back and tested our moving average. So it's holding that momentum, right? So we could come back and look for a buying opportunity, or we could wait for that mean reversion because we did get a piercing and now price has come back in. But remember, our bands in the weekly had come into coiling, and now we are expanding our bands, and both my lower band and my upper band's momentum is up. So I think we're probably going to see crude oil prices go higher in the short term than actually correct. But if I turned off my don't want to be influenced by it, right? And I looked at some buying opportunities, right? Certainly back here would have been a nice buying opportunity, but you know, we're not there, and market is now moved away. And again, I like to find where we break out and make new highs, and this one didn't really make a new high, but I do see back here where we were in kind of a sideways action and we broke out. So, you know, that would be also an area where I would be looking for an opportunity. So I'll just draw that line down here, you know, probably somewhere around in this area here, you know, maybe even up here. So, you know, I'll put it around 425-ish, but I know that I can go a little bit lower. But now moving forward, right, if our momentum is in control, you know, I might look at, you know, this opportunity right here, because this price action did what? It took out these highs. So there could be an opportunity, you know, somewhere in here, but certainly, you know, maybe right around in here where we broke out or made that move today. And again, if I go back to my 6 month and I turn back my templates, turn on my Bollinger Bands, and turn back on my moving averages, notice, isn't this kind of cool, that the one zone is in no man's land, so we will not take that trade. But the other zone, the lower one, was on our mean, and the one that I just drew would be where we re-engage, right? This could be that positive confirmation that our momentum is back into this market. So here we're using our Bollinger Bands to help us define our trend, our bigger picture, but we're also using our momentums, our MACD 9 and 18, to help us discern or confirm or look for those divergence and convergence. Okay, so where are we at a time? Wow, good, right on time. All right, let me see if we can answer a couple of your questions. All right. All right, so let me just go back here. Whoops. All right, let me start from the beginning. Why do you use a 6 month graph instead of a 3 month graph? Well, again, it doesn't really matter. I just want to look at a daily trend, right? Whatever that trend time frame. I could look at a 3 weeks, you know, or 4 weeks, or 2 weeks, or 1 week. I just wanted to do my trend analysis in my dailies, and I could use a 1 year chart. I could use a 6 month chart using weeklies, but I just want to see that more data, right? So it doesn't really matter what time frame you chart you're going to use. I just want to see a little bit more data. The more data I see, the better decision making I have. Okay. Orlando asks, can coiling be down to the downside? So I think what you're saying is, just remember, coiling is really kind of where our market is in consolidation, or it's kind of just going sideways. But when our Bollinger Bands come into those, get really, really narrow, that is actually a signal for us that we should be on the alert that our market is about to make a violent or movement, right? The bands are about to expand, and price is about to explode, and that we don't really jump on that first overbought or oversold situation, because that's as we're starting to stretch the bands, Orlando. So I think that helps that. Kevin asks, when a band is broken, how do we differentiate a snapback from a breakout? So again, when a price goes outside of 2 standard deviations and then price returns inside, that would be the conditions we're going to look for, that snapback. A breakout could come when we see when price is making a significant new high or a new low, and where my bands are narrow, right? So I'm going to look for snapbacks when my bands are wide, and I'm going to look for breakouts when my bands are narrow. Okay, Kevin? Paul asks, do longer time frames and indicators allow you to scalp futures markets in a day trading scenario? So that's a great question, all right? So yes, it does. What it does is it gives you a sense of purpose in terms of a day trader. Think about this. If I see that my market has got into an overbought situation in the weekly, and then I do my trend analysis and I see I'm in a downtrend. So as a day trader, I'm going to look for opportunities to do what? Buy the market? No, I'm going to look for opportunities to sell the market. Now, if I sell the market, I now have some targets, right? That's one of the tools that Bollinger Bands have. What are my targets? My moving averages, my mean reversions, and the opposing bands. So yeah, that's exactly what you should be using it for if you are a day trader. And that's exactly how I use it. So it's a combination of not getting caught in these lower time frames and doing all your analysis in these lower time frames, using these higher time frames to help you find some greater targets, greater probabilities, and greater opportunities. All right. We have a question that says, when we have a 20 EMA, expanding moving average, as part of our Bollinger Band setup, what is the significance of the 18 moving average? All right, so I don't know if you picked that up in the beginning, but the 18 is part of our trading system in the futures trading guide. Hang on, up here. So why I put it on top, if you think about 18 and 20, they're pretty much the same, but I like to see the two of them because sometimes there is a significant difference, right? But what I'm going to do is I'm going to look for an opportunity or a signal to re-engage my trend inside of that range between the 18 and the 20. That's kind of like my kill zone. That's where I really want to look for my structure or my entries, okay? All right, David asks, do long-term trends matter as much as they did before the huge corrections and fluctuations that have happened since the pandemic in March? Well, I mean, David, there's a lot of things going on, but I would say, trust these longer-term price movements, because when we start moving forward, some of these trends are going to really take over. For instance, we look at crude oil. Why is crude oil rallying? Well, it's rallying on the anticipation that I think I saw a news article today that London or England is going to start vaccination. So there's anticipation that economic activity is going to come back, and that could be very bullish for crude oil. So yeah, I think, I don't think it doesn't matter what time, where we are, or what's going on with our markets in terms of pandemic or any economic or global scenario. We want to trust these longer-term trends because these longer-term trends are going to give us those greater profits. Okay. All right. So we're pretty close to the top of the hour. Let's see. I have Bob's asking, is it better to use a 10 and 20 moving average instead of a 9 and 18? Yeah, I think, it's really, mishmash, right? It's mishmash. I'll give you kind of a story how this whole 9 versus 10 or 18 versus 20. So a lot of technical analysis came out of the equities world, right? And futures traders, we're kind of weird. We do our own little thing. So, we always want to try to be in front of everybody. We want to try to jump the gun a little bit. So, yeah, 10 and 20s were very common moving averages for equities, right? 10 representing 2 weeks, 20 representing a month. So some guy, I don't know if this is true, but this is kind of the story you hear. Is some guy says, "Hey, well, if everybody's looking at the 10-day moving average and they're going to make their decision on the 10-day, why don't I use the 9-day because I'm going to be one day ahead of them, right?" So I know it's kind of a joke, but there is some significance to that. So think about a data set. And if we're looking at a 10-day moving average, a data set, and I add a new input, right? So I added the 11th input, right? And I'm going to contain 10 data points to do my 10-day moving average. So that 11th input is going to be added in, and I'm going to drop input number 1, right? So I'm going to add 11, I'm going to drop 1. How many of the data points are constant? Well, 9 are. So what we're seeing in a 9-day moving average is, all things being equal, as long as momentum stays above a 9-day moving average, that is telling me that I'm in a 2-week trend. Okay, so there's 2 stories there. All right, David? Okay. Or excuse me, Bob. All right. I see another question about Keltner channels. Yeah, you can use those. Yeah, if you feel like that. But again, I try to keep it simple. I don't want to overstimulate myself. I don't want to look at a lot of indicators. I want to keep it simple. And Bollinger Bands is a really nice, easy system, because I'm going to be very patient because these events are rare, right? And it also is going to teach me, how to hold on to trades a little bit longer. Okay. All right. So we're getting closer. Oh, we're right at top of the hour. Any other questions, Jeans, that I missed?
Let's see. There were a number of people who asked if you can use this method for stocks as well, or for non-futures.
I think you can use Bollinger Bands for stocks, yes. And I would still use those standard deviations, 2 standard deviations, in 20-day moving average. So yes, you can do them, but those micro moving averages, the 9 and 18s, you might play around with that. You might look at a 5-day or a 10-day, like Bob was asking. But yeah, you can definitely use it. But I would rely on, if I'm going to trade equities, I'm going to rely on those weeklies, because those ones are really the ones that are going to give us greater significance. Okay, so good question there. So let's go back to, let's see if we can kind of tie this up in a little bow for you guys. All right, so what are the takeaways? All right, Bollinger Bands are an overlay analysis that work best with price charts and momentum indicators. Bands can be used in all time frames, but have a greater confidence in higher time frames of dailies and weeklies. I can't stress that enough. Bands don't predict price changes or trend changes, all right? They just alert us that the conditions are right? Those overbought and oversold situations. Narrow bands represent low volatility and price consolidation, and that we will be on guard or getting ready for those expanding and new trends. And that wide bands can alert us that there is that potential, that price could snap back to our moving average, our mean reversion. All right. Okay. Just want to remind you that if you are not a premium member, you can sign up on a free trial basis for 30 days, and there's where you can, the buttons to sign up. And again, I would really encourage you folks to try it out, and especially if you're a futures trader, that futures trading guide, you need to be a premium member. So there's a lot of information behind that front page that I just showed you. And that'll help you with your analysis, and you need to be a premium member to get to that information. So I would encourage you to do that. Did I forget anything else, Jean? Oh,
yeah. Let's talk about your next 2 sessions that are scheduled here.
Yeah, I knew you were going to go there.
John has 2 new webinars on the calendar.
Yeah, so next week we're going to talk about bear credit spreads, bear call credit spreads, and we're going to talk about the philosophy of. I know these are very popular option strategies among traders, And we're going to talk about the philosophy of something called in the money and at the money or out of the money. But we'll give you some tips and some ideas about what to look for, and help you to find better candidates for those. And then the Wednesday before Christmas, or excuse me, the week before Christmas, we're going to have a little bit of different type of webinar. It's not really going to focus a lot on the tools or pages that are in Barchart. We're going to talk about how to build a successful trading plan, and I'm going to give you some general ideas, some food for thought to help you build a trading plan. And I really believe, as as a mentor or an educator, that it's important that I teach folks how to build a trading plan, because without a trading plan, you're really planning on losing money, and that I can't emphasize that enough. So that, I think, it's going to be a little different, but I think you will definitely enjoy that one. So I look forward to having you folks sign up for that one. So until then, wish you all the best of health and the good of all trading, and safe travels for everyone.
Thank you again. Bye-bye.